Tesla stock is up about 0.5% in after hours, following some haymaker earnings from Meta, Amazon, and some disappointing numbers from Apple. All of that here in this video, but let's start with what the heck Cathie Wood just said about Tesla, robotaxis, FSD, the whole shebang. We also have very important economic data coming out tomorrow morning in which could totally derail stocks. The expectation that Goldman Sachs has could be bad news tomorrow. If, of course, Goldman Sachs is correct, and we'll go over all of that here in this video. Cathie Wood's ARK Invest sees 95 to 100% of all vehicles on roads as EVs by 2030 and predicts a death spiral for legacy automakers. That's one of those headliners that will come back to haunt you by 2030, or the I told you so moment. In other words, some very strong conviction levels Cathie Wood has on Tesla and just the overall EV technology. And you guessed it, they believe Tesla is best positioned amongst rival players to ramp robotaxis. ARK sees electric vehicle sales scaling at a rate of 33% annually over the next 7 years to touch 74 million vehicles in 2030, aided by easing supply chain disruptions and subsequently lowering EV prices. But check this out. ARK Invest believes robotaxi platforms can generate $28 trillion in enterprise value in the next 5 to 10 years, with a majority of that likely going to Tesla, as it's pretty dang hard to develop self-driving features in general, let alone a robotaxi network that is operational. Like, how many players do we think are really going to compete in this area of a new market? Maybe Tesla, Waymo, maybe Baidu in China, but other than that, it's really hard to see anyone else. We know Cruise just had major setbacks, which ultimately is negative in the short term for Tesla as well, but Cruise may not even survive. Cathie Wood says EVs are gaining market share and negatively impacting the share of combustion engine vehicles. If EV adoption continues to scale, traditional automakers may be forced to restructure and consolidate, the company said, while noting the struggles of legacy automakers like General Motors, Volkswagen, and Ford in scaling EVs. Cathie Wood says this is getting worse by price cuts from Tesla because Tesla essentially can afford to cut prices when these other guys cannot. And again, Cathie Wood reiterates the belief that robotaxi platforms can generate $28 trillion in enterprise value in the next 5 to 10 years. This, for context, is 9 times the value of all auto manufacturers in 2023. Robotaxis are currently operating in about 20 cities across the globe with fully driverless commercial options in at least 7 cities. Cathie Wood says, quote, with access to 50 times more driving data than Baidu, 280 times more than Waymo, Tesla has a massive data advantage as it prepares to launch its robotaxi service, the largest AI project in the world. Tesla has already started rolling out version 12 of its full self-driving software, which is expected to make the cars capable of autonomous driving without human intervention. Just imagine if Tesla came out and said they were going to actually launch the robotaxi service with the new V12 version of FSD. I mean, that is a lottery ticket catalyst just waiting to be announced. Elon Musk, back in 2019, was talking about the robotaxi platform. Then in April of 2022, Musk predicted Tesla would achieve the volume production of robotaxis in 2024. He said at the time, quote, we aspire to reach volume production of robotaxi in 2024. It will be a massive driver of Tesla's growth, Musk then told investors. During the company's second quarter earnings call in July of 2023, he reiterated the idea, saying, in the long term, autonomy we think is going to just drive volume through the ceiling next level. Now, the beautiful part about Tesla, and when Tesla launches the robotaxi, it should be a pretty mass market launch. It should not be a city by city thing. Even if you do have to go through the regulation processes in each city, you should be able to do a lot of that all at once. So just imagine if Tesla is able to capture 50% of that overall market. If Cathie Wood is correct and it's $28 trillion, $14 trillion of enterprise value for Tesla would mean a 2,000% return on your Tesla stock today, let alone Optimus or anything else Tesla has going on, energy storage, purely selling vehicles. The opportunity is literally off the scales. Elon said on the last conference call that just Optimus alone, you could have infinite productivity, thus infinite growth. Let me know what you think about what Cathie Wood just said down below in the comment section. So yeah, the winners here in After Hours are definitely Amazon, up over 9%, and Meta, up 14%, whereas your loser so far is Apple, down about 1.5%. Meta pretty much crushed it with EPS of $5.33 versus estimates of $4.96. Revenue beat by about $1 billion. Daily active users came in at 2.11 billion versus 2.08 billion as expected. Monthly active users eked out a little beat, and your average revenue per user came in at $13.12 versus $12.81 as expected. What is really causing Meta shares to jump 15% in After Hours is the unexpected dividend announcement. Meta says that they will now pay 50 cents per share per quarter indefinitely. This is not a one-off. This is a new dividend that will be around forever, hopefully. Meta also announced a $50 billion share buyback, adding to their $30 billion that is still authorized, leaving Meta accessible to purchase about 80 billion worth of their own stock. Meta tends to have an outsized influence in our markets because a lot of companies rely on advertising, and if revenue is good at Facebook, it's probably good at other names also. Amazon is currently up about 9% in After Hours after beating on both top and bottom line and giving some optimistic guidance for Q1. Amazon's earnings come in at $1 per share versus 80 cents per share as expected. Last year in this quarter, Amazon only brought in 3 cents per share. So going from 3 cents to $1 per share, that's huge. Revenue beat as well, coming in at $170 billion versus estimates of $166.2 billion. Amazon Web Services came in line with estimates. That's one reason why I'm a little surprised Amazon is up almost 10% in After Hours, because Amazon Web Services did not beat. It just came in line with estimates. And in this market, it doesn't seem like coming in line with estimates is quite enough. And then advertising came in at $14.7 billion versus $14.2 billion. Amazon said first quarter sales will be between $138 to $143.5 billion, representing growth of 8 to 13%. Analysts were expecting revenue of $142.1 billion. So it wasn't even that much of a guide up. They lowered guidance on the low end range and it's higher on the high end range. But I think Amazon, some people were kind of fearful about AWS and if that could miss. So that's probably why Amazon is up excess of 8% in After Hours. Last but not least, Apple is down about 1.6% here in After Hours. Apple beat on EPS, coming in at $2.18 per share versus $2.10 as was expected. Revenue coming in at $119.58 billion versus $117.91 billion as was expected. iPhone revenue beat by about $2 billion. Mac revenue beat just a little bit. iPad revenue came in light, about 300 million light. Other products revenue beat estimates by about 400 million. Services revenue, this is probably what is causing Apple to fall. Service revenue came in at $23.12 billion versus $23.35 billion as expected. The reason people own Apple is not for iPhones. It's for services and the App Store. Gross margins, they basically always beat as well this quarter, coming in at 45.9% versus 45.3%. Apple reported 2% sales growth in the December quarter, breaking a streak of 4 straight quarters with annual revenue declines, which that's just crazy in and of itself. Apple's almost at all-time highs and it's seeing declining revenue growth. If that happened with a Tesla would be a $50 stock. The second piece of bad news on Apple's earnings was a 13% decline in sales in China, one of Apple's most important markets. And maybe Apple's revenue just only falling 13% in China can be seen as good news, because maybe the estimates people's expectations where China could collapse even more than that. So long story short, I think the reason Tesla stock is actually up following these earnings, keep in mind, Tesla does not sell products like Amazon. Tesla does not sell iPhones. Tesla does not really advertise. They don't make money off of really any of these other business models that we heard from today. But I think China just came in a little bit better than expected, which China could be the most important market for Tesla in 2024. So if people are still buying iPhones, people may still be buying Teslas as well. That seems to be the main reason why Tesla stock is going higher here in after hours. Let me know your opinions down below in the comment section. Keep in mind, on Apple's conference call, we will not get definitive guidance. We will not get a number to go off of, but they will provide some clarity on how this quarter is going, and that's what is going to drive either a bounce from here or a decline. These earnings are collectively causing the S&P 500 to rally about 0.6% in the after hours. So as long as tomorrow is not a dismal non-farm payroll report and unemployment rate, stocks likely continue higher from here. On that note, we have a little bit of a problem. Tomorrow morning at 8:30 in the morning, non-farm payrolls are going to be released. Markets are expecting 180,000 job ads. Goldman Sachs came out with a new note. They say we do not place much weight on the ADP miss because of ADP's negative correlation with BLS private payrolls since the introduction of the new methodology. So ADP is the private institution that does the jobs report. They get a different number than non-farm payrolls every single time. And that came out on Wednesday. It came in about 45,000 jobs lighter than expected. Goldman Sachs says we left our non-farm payroll forecast unchanged at over a 250,000 job ad for the month of January. So if Goldman Sachs is correct, you are going to add 70,000 jobs or more higher than the estimate coming tomorrow morning. The Fed made it very clear yesterday that we can see a strong economy. We can see a strong labor market as long as inflation continues to fall. But in fact, it does not look like we're seeing much progress on inflation over the past month or so. We're getting some pretty inflationary readings, even in the data we got today. ISM manufacturing PMI beat across the board, but the thing that beat the most, go figure, was ISM manufacturing prices paid. This came in at 52.9. The estimate was 46.9. So this came back into positive territory. That's not great and really creates a bit of a problem because Fed Jerome Powell also made it very clear if they don't need to cut rates, they're not going to. Jerome Powell actually said he thinks it's more likely that inflation comes down, but not quite to 2%, meaning they might have to stay there higher for longer or even raise rates again. If you continue to see a strong labor market, strong economic activity, the Fed's not going to cut rates. So in theory, we could see rate cuts get pushed out to 2025. We may not get a rate cut in 2024 if the labor market remains strong, if the economy remains strong, and inflation kind of stalls out here. Ultimately, the worst thing for stocks is a recession. Recession will cause much larger downside than if the Fed did not cut rates, but still, that's a bit of a problem when markets are expecting 6 rate cuts in 2024. I mean, there's a chance we could get a huge non-farm payroll number next month. I mean, there's a chance we could get a 300,000 number for the jobs report tomorrow. The markets are going to have to seriously unprice the rate cuts that have been priced in. Markets are still, as I said, expecting 6 rate cuts with 41.8% odds. 7 rate cuts sit at 21.9% and 5 rate cuts at 26.8%. So you're almost pricing in a higher likelihood for 7 rate cuts than for 5. That's expecting some weakness in the economy, in the labor market. If we don't see that, markets could very soon start to price in 4 rate cuts. What does that do for stocks? I would imagine causes some downside. And that, my friends, could be a problem tomorrow. Now, my personal opinion is non-farm payrolls come in about 200,000. So a little bit on the hot side, but not too hot where markets say, yeah, we're not getting 6 rate cuts. We need to aggressively unprice that. So I'm more in the dovish camp, if you will, for tomorrow. I don't think tomorrow's number is going to be so hot that we start to question whether or not we do get rate cuts entirely. But I'm still expecting a number higher than 180,000, around 200,000. That still wouldn't reinforce the Fed's going to cut rates anytime soon. Current odds are 58.4% for the May rate cut. A non-farm payrolls number coming in 200,000 or higher could send down these odds a lot. Now, that is all potentially a problem. The unemployment rate will also come out tomorrow. We're expecting 3.8%. That would be just fine. That would be awesome. Give us a little bit hotter non-farm report. Give us an unemployment rate that goes from 3%, 3.7% to 3.8%. That would be a little bit of a more mixed bag, but if you see the unemployment rate fall to, let's say, 3.6%, yeah, you might completely unprice the rate cut in May. Good news is earnings came in good. That is causing stocks to rally as we speak. NASDAQ 100 futures are already up about 1%, and the market just opened not too long ago. The bad news is if we do get a jobs report that is 200,000+ jobs, that's going to be seen as likely bad news for markets because, let's be honest, we weren't pricing in a March rate cut heading into yesterday. The Fed said we're not getting a March rate cut. Stocks still sold off, even though it technically wasn't priced in. I think a lot of stocks are trading for 6 rate cuts in 2024. If that narrative substantially gets pushed back tomorrow by a lower than expected unemployment rate and or a higher than expected monthly job ad, that's not going to be fantastic news for a lot of stocks. My personal opinion is if we do get a hotter than expected jobs report, let's say above 250,000 job ads, it may offset some of the good earnings that we just seen from Meta and Amazon because those stocks are already trading at all-time highs. So it's a lot easier to sell off a stock that's trading at all-time highs than to sell off a stock that's trading at 52-week lows on better than expected earnings, right? You can question the valuations here. Like, do they make sense for Meta, for Amazon, for Apple, for Microsoft, and for Google? If the stocks were lower, it would be hard to make an argument with their valuation. Speaking if the numbers were the same, but just the share prices were lower. So I don't necessarily think these earnings are just a free and clear, we have a path towards higher levels in the markets. I do think there's a combination of different things going on right now. And to see stocks going higher, you need the best possible outcome possible. You cannot get a 250, 300,000 plus job ads number, or markets are not going to like that. As for Tesla's stock, good news is, as per kind of the overview I just gave you, Tesla stock has fallen a lot, so it's already very low. It's not trading at the highs. So in that case, Tesla stock could be a little bit more insulated than some of your other names, even a Meta or an Amazon that just reported good earnings. Let me know what you think about this information down below in the comment section. What is your expectation for tomorrow? And how do you feel about these earnings? Do you think they are enough to continue to send stocks higher, or is this getting close to the top? Let me know down below in the comment section. Hit the like button as well as subscribe to the channel if you made it to the end of this video. If you guys want to come trade with us live in real time, check out that link down below as well in the description of the video. You guys have a great rest of your day. My name is Michael Tyler, and I will see you in the next one.